What if I told you investing into the stock market doesn't have to be complicated? It's actually just as simple as buying one index fund. In fact, one of the most successful investors of all time, Warren Buffett, said that for most people, the best thing to do is just to invest into a low-cost index fund and hold it for a long time. That's it. In this video, I'm going to be breaking down the 5 best index funds that will help you build real wealth. No stress, no guessing, just smart, proven investing. Okay, so before we get into the index funds, we need to ask one important question. What is an index fund? Basically, an index fund is a type of investment that tracks a group of stocks. For example, one index fund might follow the S&P 500, which is a collection of America's 500 biggest companies. Another might track the FTSE 100, which is a collection of the UK's top 100 companies. The point of an index fund is simple. It copies the performance of a group of stocks. So instead of buying the 500 companies one by one, all you have to do is just buy the index fund. And that one fund automatically spreads your money across all the different companies. It's an easy way to stay diversified, and it costs way less than putting your money into a traditional mutual fund that is run by somebody trying to beat the market. An ETF, which stands for Exchange Traded Fund, is just like an index fund. An ETF also tracks a group of stocks like the FTSE 100 or the S&P 500. But the huge difference is how you buy and sell them. With an index fund, you usually buy it through a retirement account or from the fund company. And it only trades once a day after the market closes. Plus, a lot of index funds have minimum investment amounts like $1,000 or $3,000 just to get started. And some might even charge fees if you're buying outside of their platform. ETFs, on the other hand, trade just like regular stock. You can buy and sell them anytime the market is open and there's no minimum. You can invest with literally just $20 if you wanted to. And here's something most people don't realize. If you're using apps like Fidelity or Robinhood already, you're probably buying ETFs without even knowing. This is because those apps are made for real-time trading. They make ETFs easier to access, especially for beginners with less amounts of money. Another bonus, ETFs don't charge extra fees if you're buying across different platforms. So unlike some index funds that charge you fees if you buy outside their home company, ETFs are usually commission-free no matter where you buy them. For example, you could buy a Vanguard ETF using Fidelity or a Fidelity ETF using Schwab. You won't get hit with any extra fees. So both index funds and ETFs track the same markets, have low fees, and are great for long-term investing, but ETFs are more flexible and are easier to start with. Now let's get into the most fun part, the ranking. Starting us off at number 5, we're looking at an international stock market index fund, a fund that lets you invest into companies outside of the United States. This is important because while the US economy is strong, it's not the whole story. Global diversification helps you reduce risk and gives you access to growth in other regions like Europe, Asia, and other emerging markets. The fund I like in this category is VXUS, which is Vanguard's Total International Stock ETF. In the mutual fund version of this ETF is called VTIAX. These both have an expense ratio of just 0.05%, which equals out to about $5 for every $10,000 invested, making it a very efficient way to get exposure to the global market. VXUS holds over 7,500 stocks from more than 40 countries. This includes major markets like Japan and the UK, and emerging markets like India, Brazil, and China. So it's incredibly diversified across the entire globe. And we're not just talking about small companies. This fund includes some of the biggest names like Nestle, Toyota, and even Samsung. Now the downside is performance. Over the last 10 years, this fund has had an average annual return of only 4 to 5%. Which, as we know, is a bit lower than US-focused index funds. Although it hasn't outperformed recently, there have been times in history where international stocks have outperformed US stocks. So having some exposure, even if it's just a little bit like it is in my own portfolio, can be very useful in the long run. That's why I rank it 5th, because I don't think you should use it as the core of your portfolio, but once you've got a strong base in the US market, adding something like VXUS is a great way to lower risk and spread your investment across the globe. This fund is perfect for adding to a simple 2 or 3 fund portfolio, and it's a great way to cover your international portion without overcomplicating things. At number 4, we're looking at a Dividend stock market index fund, a fund that focuses on strong, reliable companies that pay a consistent dividend. Dividend funds are great for building long-term wealth while generating income along the way. They're especially popular for people who want to mix growth with stability. The fund I like in this category is SCHD, which is Schwab's US Dividend Equity ETF. It has a super low expense ratio of just 0.06%, which means you're only paying $6 a year for every $10,000 invested. SCHD focuses on large US-based companies. These are all companies that have steady earnings, strong balance sheets, and a solid track record of paying and growing their dividends. It currently yields around 3.5%, which is solid for a fund with this level of quality. It holds about 100 companies, including names like PepsiCo, Broadcom, and Cisco. So you're getting exposure to top-tier companies with dependable cash flow and proven track records. Over the last 10 years, SCHD has returned about 11% annually, which is actually better than a lot of growth-focused index funds, especially considering the low volatility. This fund is not meant to explode overnight, but it gives you reliable performance, income, and long-term upside, making it a great addition for any long-term portfolio. I rank it fourth because while it's not my highest growth pick, it brings stability and income. And number 3, we're looking at a growth stock market index fund. A fund designed to focus on fast-growing companies with strong earnings potential and long-term upside. The fund I like in this category is SCHG, Schwab's US Large Cap Growth ETF. This fund tracks about 240 of the biggest growth-oriented companies in the US, and it does this with a super low expense ratio of just 0.04%. Again, that's only $4 a year for every $10,000 you invest. SCHD leans heavily into sectors like tech and healthcare. It includes the biggest names like Apple, Microsoft, and Amazon, so you're getting exposure to the biggest companies with the best innovation. What I really like about SCHG is that it balances explosive potential with diversification. And unlike similar funds that only focus on tech, SCHG spreads your investment across a bunch of high-growth industries. This helps reduce the risk a bit while still delivering high upside. Over the last 10 years, SCHD has returned around 13.5% annually, slightly below something like QQQ, but at a much lower cost and a more diversified mix. If you're someone looking to tap into long-term growth while keeping fees low in your portfolio broad, SCHG is a great option, and that's why it earns the number 3 spot on this list. And number 2, we've got a classic, the S&P 500 Index Fund. This fund tracks the 500 largest publicly traded companies in the US, and it's one of the most popular ways to invest for long-term growth. The fund I love here is VOO, Vanguard's S&P 500 ETF. The mutual fund version is VFIAX. Both give you the exact same exposure to the same 500 companies, and they both come with an ultra-low expense ratio of just 0.03%, the lowest so far on this list. That's only $3 for every $10,000 you invested. When you invest into VOO, you're getting a piece of all the industry leaders. This includes companies like Apple, Microsoft, Nvidia, Google, the list goes on. It's super diversified across a bunch of industries like tech, healthcare, consumer goods, and more, which makes it a great long-term core holding. Just the top 10 companies alone account for 34% of the fund's mix. The performance backs it up too. Over the past 10 years, the S&P 500 has had an average annual return of around 12.5%, which is incredible for a fund this broad with such a low cost. This fund isn't flashy by any means, but it's reliable, time-tested, and simple. If you want to set it and forget it and let your money grow with America's biggest companies, VOO is one of the smartest ways to do it. Now you're probably thinking, if this is so great, why are you ranking it number 2? There's one more fund that gives you everything VOO does and more. The number 1 type of index fund to invest in is the total US stock market index. Why, you might ask? Because it gives you full exposure, not just America's top 500 companies, but also thousands of mid-cap and small-cap companies in the US. The fund I like is VTI, Vanguard's total stock market index ETF, and the index fund version is called VTSAX. Both are extremely low cost with just a 0.03 expense ratio, meaning only $3 for every $10,000 invested. And they both currently hold over 3,600 US-based stocks. The top 10 holdings of VTI are exactly the same as VOO. Apple, Microsoft, Amazon. But in VTI, they make up a smaller portion of the fund, around 29.7%. This leaves room for the smaller companies that can explode over time. Now, here's something important to remember. Today, VTI and VOO have an 88% overlap, which means although that these are the top 2 choices on the list, you don't need to own both. Pick the one that fits your investing style. If you want pure large cap exposure, go with VOO. But if you want broader exposure and higher potential from smaller companies in the long run, I'd go with VTI. Over the last 10 years, VTI has had an average annual return of around 11.6%. Now, although this is slightly under VOO, the added diversification might pay off big in the future. And that wraps up my 5 best index funds that you should consider for long-term investing. Of course, none of this is financial advice, but considering all my research and my years of investing, I truly believe that these index funds are all you need to reach your investing goals. Whether you're building your Roth IRA like we've covered in other videos, or just investing into a regular brokerage account, keeping it simple works and has made countless millionaires. If you found this video helpful, give it a like and subscribe for more personal finance and investing tips. Let me know in the comments which fund you like most, or maybe one I missed out on. I reply to every single one. Thanks for watching, and I'll see you in the next one.